Hey guys, welcome back to the Capital Mindset Show. Today we're going to be looking at HP stock, specifically of which one we're going to look at HPQ stock. All right, we're going to be revisiting this stock. We did talk about the stock in the past, and I'll actually go over that with you guys here. Actually, I should be pulling that up right now, but essentially what we did discuss in the past, and we'll pull up the date on Capital Mindset. This was a very cheap stock, right? So we took a look. We took a look at all the financials. We did actually say that this was like a buyback story. So we also looked at HPE, which is HP Enterprise, and in essence, what we discovered between both of them is both are extraordinarily cheap relative to what they could grow at, and it all depends on the average buyback you assume, okay? The return on capital. That does actually change the story quite drastically. And I think, I have a hunch that that is exactly what Buffett was actually implying here. So I'll show you guys right here what I mean. So we take a look at the desktop. We actually see this was posted on January 10th, 2022. I can tell you it wasn't actually filmed on this day, or it was filmed, I think, the day before or something like that. But it was posted on January 10th, 2022. Here, the price was actually, I think, the same where it is now. And there was a little bit of excitement going into it because Warren Buffett has purchased HPQ. And so a lot of people might feel as though HPQ is some sort of a buy. Okay, so we'll take a look at the price action real quick, and you can kind of see here it's the same price as when we kind of discussed it then. It's not in my portfolio as of yet. I haven't made any decisions whether or not I want it in my portfolio, but this video will serve as a conversation to be had of sorts, whether or not today it is a good value. And I feel as though I'm just going to be repeating a lot of the same things in this video, just in perhaps hopefully a better format, okay? Because again, I have been getting better, hopefully, at making videos and providing content to you guys. So taking a look at the 1 year chart, we can kind of see they've gone through this up and down, up and down, up and down, and this massive run up, well, not massive, let's not exaggerate here. This run up right here, 14% was Warren Buffett, or Berkshire Hathaway to be very precise, purchasing HP stock. So this is a legacy company, very boring company. Just looking at the gap PE ratio metrics, we have a 6.85, dividend yield about 2.6%, market cap about 40 billion. And when you look at HP, let's actually kind of show everyone this because I think it's from the consumer standpoint. This is the enterprise that focuses primarily on selling, the computers, printers, and the like, okay? You can go through their own website, but here you go. You got the printers right there. This is a cash cow business. So just so everyone kind of understands. Then there's HPE, which is HP Enterprise. We won't really be going into this video, but maybe I'll throw it in the model, but we'll see. All right, so let's go over to the presentation and get an idea of what the sales pitch is for this business. I'll zoom in just for those of you who look at this through your cell phones. I just want to be accommodating to you guys. And looking at okay, so this is the key growth areas. This is important to understand what the company is kind of thinking about. So gaming, I personally don't have anything HP. I prefer to build my own systems, but some people don't like to do that. And then they might have a good business segment there, right? If you don't want to assemble anything yourself, all well and good. Even though right now, funnily enough, it's actually cheaper in some instances to buy pre-built than to buy the pieces separately. So, but anyway, that's a little bit of what they do. I think Omen is their brand. Peripherals, 40% of revenues come from across HyperX, HP branded peripherals, leading cutting edge innovation, including a HyperX Cloud, Alpha wireless headsets. Okay, so peripherals, think of like headsets and stuff like that. And we talked about other companies that sell peripherals like Corsair Gaming, stuff like that. They also have workforce solutions and consumer services. So this is interesting, the DaaS business model, the device as a service. And so that's basically, it takes off the ownership off of the customer, and then you are just basically, in a way, leasing it out to them through like a subscription. And then consumer services, we have Ink. That's the thing I'm talking about regarding the cash cow. Now, there comes a time where we actually see the growth side, right? Where I think that there could be a lot of hype in the future. So there's a lot of hype in terms of 3D printing. We have ARC, Invest getting into 3D printing, but with specifically HP, they are also in 3D printing. You see this down at the bottom with a 3D segment right here. So that's 3D printing essentially. And then industrial graphics. All right. So there you go. It's a 3D printing company to the moon. All right. So results overview, we don't really care about that. This is something that because we're going to look at in the model. This is something that we want to pay attention to. So the breakdown of revenue, we have Americas, EMA, which is like the European region, and Asia Pacific. So Americas obviously is the largest part, and I think that includes Latin America. Latin America is 7% of that, and 33% is coming from the United States. Well, Canada and Latin America is 7%. So very small. Basically, it's entirely United States. And let me see, to say the growth. The growth is actually coming from, of course, Asia Pacific. Americas is like a cash cow, and then EMEA, is growing at about 8%. So that's fine. Looking at the breakdown, we do see the most important segment in terms of revenue is notebooks, right? Hopefully they break down the profitability, but that's just the net revenue. Printer and consumer, printer commercial, these make up 10% in total. Printing supplies, so a lot of printing. If you add that up, that's 28%. Workstation and other personal systems, and desktop, 17%. Okay, so revenue growth. So revenue growth, we can see here that it grew a lot here in Q2 2021. That's probably because of the work from home environment. But we do see prior to this, there was subpar performance. And we'll actually take a look at that when we get into the model. We'll see what the trends look like. Regional revenue trends, we already kind of know what that is. Asia Pacific is doing the best, and we can see that here. The United States is kind of stagnant. Americas in total is stagnant. EMEA is EMEA is kind of normal. Taking a look at revenue, we have 12.2 billion in terms of personal systems, and operating profit is 957 million. So, it's below 10% profit margin there, or operating margin. This one we can see here is actually above. All right, so that's above the 10%. So printing, again, is the high margin business, and you can just do some quick maths. That would have to be about 8.79 billion in order for that to be 10%. So we're above that. Actually, I think we're above the we're either just at or just above the 20% mark. Accelerating ESG impact. Okay, I don't care because that's a pat on the back. So this doesn't really change for the investment proposition. This is kind of like a pat on the back slide. They usually just like pat themselves on the back. It's nothing big. All right. Looking here, so like cash and debt balances, net cash and debt. Okay, so they're trying to say, oh, look, we're so well capitalized, all cool and stuff. And then cash flow. So cash flow, this is a very important slide. This hopefully shows us exactly what we want in terms of, okay, so they already do the free cash flow measure. That's great. And so in full year 2021, it appears as though they're going to have higher cash than full year 2022. Concerning? Yes. So we actually have a decline in cash or cash flows, and we'll take a closer look at that. But shareholder return. Okay, so what's going on here? Dividend, share repurchase. So are they slowing down? I think they are slowing down. So this is another concern because again, full year 2022, it seems like they slowed it down from full year 2021. So, and that's again their reporting year. Okay, unless this is a continual added. They don't say that. Yeah, they don't say that, which is weird, because if they do that, they should tell you that. Actually, no, this answers my question. So yeah, ignore what I said before, because you see how these numbers are the same? This is how you can tell. So we've only done 1Q of 2022. They should actually let you know with an asterisk, and I don't see that they have. So that can confuse a new time investor looking at this and saying, okay, it almost got me there. So this is a rolling sum. So essentially what that means is it's only taking into account Q1 2022. So we don't have Q2, Q3, and Q4. So we're going to go off of this as kind of like a smell test, and we're going to think that they're going to achieve something along the lines, because they are doing more here. And then let's take a look at what they've done here. So they are returning more in this quarter than in the quarter of the previous year. These are the same numbers. This is the same number as Q1 for now. When we get to the next quarter, this number will be larger because it's a rolling sum. And then it's going to add whatever this quarter was plus the next quarter. Hopefully that makes sense. And then that's why this one looks so drastically larger. So it looks like for now, the trend is that they're returning more. So it's accelerating in terms of dividends and share repurchases. And specifically, it is the share repurchases that I'm going to be focusing on because as I stated in the old video and also in the live stream, which hopefully you guys actually enjoyed. But in that live stream, I stated that this appears to be a basically like a cash cow and just focused on returning cash flows to shareholders, which is all well and good. All right, so more patting on the back, ESG stuff, and I already had that discussion with you guys about ESG and the nuances of ESG. Like you actually do want some sense of that, but for obvious reasons. But the problem is a lot of companies, they just like take it to like some extreme where they're just like thinking that shareholders like are going to be so impressed by their ESG commitments, which isn't really like that crazy because there's like applicable ESG and then there's like patting on the back ESG. All right, so working capital metrics is okay. That's all well and good. I think we're good enough to go to the model over here. So let's actually type in our HPQ. And let's see what comes up. I'll go over here because I know some of you actually like to see the management team, how much they're getting paid on a public basis. I mean, you can see the gender, the year born, if you guys care about that. All right, so you guys can pause the video and watch that. All right, so neutral from analysts, beta of about 1, so it's actually more in line with the market. Price target of about 38.84, implying a 0.99% upside. When we, I think, originally took a look at this, it was not. I think it was just above what analysts have it as a price target for. And yeah, this is a legacy business. It has positive sentiment more recently, I think, because of the Warren Buffett effect. So let's actually take a look at some of these other key metrics. So taking a look at the return on invested capital, this is actually really good. And I already looked at this on the live stream, but for those of you who didn't look at the live stream yesterday, the ROIC has been consistently really high. And that's something that Buffett really likes. Total debt ratios, pretty good here. And let's actually make sure that we're not doing an unprofitable analysis. Good. So that's all good. And let's actually put in our 12% discount rate. So they don't even have to grow. I don't have to go any further from here. They don't have to grow. They actually don't need a buyback, and they would already be technically a buy now. So it looks extremely cheap, but that's with the 12%. Let's go with the 15%, get that margin of safety. Basically, they're there right now. No growth, no buybacks. They're good to go. And let's take a look at the buyback rate. So now this is what I'm telling you. It is a buyback story. I think Buffett actually does believe that the amount of shares, the cannibalization, that's how he calls it, where businesses cannibalize themselves when they're not really wanted by the market. He would like to own stuff like that, right? That's one of the things he likes to own. He looks for that, but he looks for durable moats. And I think he sees in HPQ a durable moat, a boring business that no one really wants to get into. And they're going to utilize these cash cows and kind of expand into something like 3D printing. That's my understanding of this. So taking a look at the buyback so far, and we kind of just do slightly less than what they've done in the past. We can see that the fair values are printed out right here with 0% growth. Let's actually see what happens if because even with a even greater margin of safety, it looks like we're in the green. And let's even go further. We're still in the green. So basically what this implies is you can actually, with these discount rates, you can kind of mess with the assumptions a lot. For example, like you have a lot of room for error, basically. So this is a good example, and we discussed this in the live stream yesterday, that this is a good example of heads I win, tails I don't lose much. And so it's an interesting prospect. I would not actually be, I wouldn't think anyone is crazy for actually buying the stock. I think this is actually an example, and I'm being objective here because I don't own this stock. So, and I don't really have plans of buying the stock. So I'm kind of coming at this from an unbiased perspective, right? So oftentimes I think it's good that again, you guys are the ones who drive the content on this channel. I don't pick my stocks that I'm invested in. You guys probably noticed that. My portfolio is public, and I'm never going to charge for that. So you guys probably noticed that most of the videos I produce on this channel aren't about those stocks. It's mainly about the subscriber requests. So this one was on there. I was requested yesterday also in the stream, but that person I guess didn't know I was going to make this video because it was in the schedule. So here I am making this video. And again, I don't own the stock. I do, again, see the appeal. And the balance sheet looks pretty good because I'm seeing on the Altman Z-score we have, a favorable ranking, and also the model's own measure is actually saying the same thing. They almost like never deviate from one another, by the way, if you're wondering. Now, taking a look at the revenue, this is where I will start to say that I would actually be modeling in a negative growth or stagnation, but slight negative, because I do think they're going to face some pressures in some of their legacy business models or legacy businesses. Specifically, I think within printing, but 3D printing might be a growth avenue. And, for some of the other stuff, I don't really like those businesses like peripherals. I don't really like that. I've stated that, for example, in the videos about Corsair gaming, even though I prefer Razer products, it doesn't mean I'd buy Razer. I did state in previous videos that of the two, if I had a gun to my head, I probably would buy Razer. But I think, for example, Logitech, of all three of them, is perhaps the best one because of how they actually structure their negotiations. HP does so in a very similar fashion. So I think HP and Logitech are very similar in that capacity. But HP has a lot of other businesses that Logitech doesn't have that actually strengthens HP, I think, in my opinion. Now, taking a look at the cash flow estimates, cash flows are actually estimated to grow drastically in the next year, according to these analysts. But when I took a look at, for example, the sales are actually estimated to actually stagnate or go down. And then depending on what I really where I really get my sources from, because I've also seen some instances of analyst estimates estimating that it'll be about 5% growth and then decline. So then these analysts are estimating the decline happens a little bit sooner rather than later. I think, for example, taking a look at the trend line here, it does appear though, and take that trend line with a grain of salt, because this trend line is actually taking into account this massive drawdown right here, because this is the split of the company. So I actually won't take into account this, but it does appear that we are definitely growing past what was the average growth rate over the past these years. So I do think that it might actually come down a bit. Okay. And then remember that when I said that statement in the cash flows over here, because I think I should go back to make sure I correct this. So this drawdown, or I already corrected it, but just to remind you, this drawdown is because this is a rolling sum, not what they're saying that the full year will be. It's a rolling sum. And taking a look at what the cash flows were this same time this year, it is 60-ish% higher. So we do actually see that this year, perhaps these cash flows are going to be accurate, right? These higher cash flows. But going back up here, we probably, I don't want to model in too much growth, okay? But what I'm trying to show you guys is that you don't actually have to assume that much growth. We're basically discounting this thing at 30%, and we're still kind of getting that it's a decent price. Now let's be a little bit more serious in this aspect, and let's actually see what kind of declines we can assume. So -5%. Well, actually, let's see if we can model in a -10% decline. Okay, not too far away from that, by the way. So I'm assuming in that instance a decline of 10% every year for 10 years, and then we see a -7%, -5%, -6%. Actually, let's change that to yeah. I'll stop there because the rest I'll just keep at 0. And I'm implying that let's even actually draw it down. So we say it's more likely that this occurs. So let me explain what this means. So when I say no here, I'm saying that I don't know which one is the most likely to occur. So they're all equally weighted. Okay, each and every single one of them is equally weighted in terms of probability of occurring. And then if I assume yes, their higher probability of occurring is 15, 60, 15, 8, and 2. The model is actually telling me based on all these assumptions, and it takes into account the likelihood of bankruptcy and stuff like that, it implies that I could actually make this a 9.26%. And that's its opinion. I don't follow its opinion like law, but it's kind of like a flag post that I actually look for and kind of think about or take into account. So there might be a reason as to why all of this, or why this stock is so cheap, right? It does appear that for some reason, the market is not pricing this according to perhaps what it should be. And maybe Buffett sees that too. The short interest is only about 5-ish%. So it's not like there's a huge bet against this company. 5% is higher than what I would think. I do think that it might be the case that there might be a drastic decline being priced in. And if that doesn't occur, again, you're in a situation where Heads I win, tails I don't lose. And again, I'm not invested in the stock, so you're not really getting a biased opinion. I'm not going to benefit if the stock goes up. I do, however, leave open the opportunity that I may purchase the stock. So I'm not saying I'm not going to purchase the stock, but I don't have it right now. Okay. And I have no plans on buying it. I might buy it though. I don't know what happens tomorrow and I change my mind. So yeah, let me know what you guys think about this company. Let's actually finish off with the ratios to kind of get an idea. But we see that the current ratio, it's not too good, but it's not terrible for a business like this. Total debt ratio, long-term debt ratio, pretty good, really well capitalized. I mean, we already kind of saw that with the two measures of bankruptcy. They are actually showing some improvements in some capacity. Gross profit margin is actually where we're seeing a good run up, about 300 basis points almost in terms of the from 2020 to 2021. The ROIC is consistently good. I love that. And then earnings quality is also almost consistently good. 2021 is just kind of a little bit on the bad end. Same with 2018. But for the most part, it's consistently good. But yeah, I think that's fair. And then let's take a look at the earnings sentiment and stuff. We see a sentiment score about 1, so it's above. So it's probably again driven by Warren Buffett. Vendors ship more than 800. Okay, so kind of looking at these articles here. You can pause here and just read that. Berkshire Hathaway, Warren Buffett purchased stock in the tech giant. Okay, so then this was published on 4/9. Okay, so days ago. The more recent one is this one. Vendors ship more. Okay, top picks for now. What does Warren Buffett see in HP? Okay, so all that stuff. I think on that note, I'll just leave it off there. Thank you guys so much for watching, guys. If you guys enjoyed the video, go ahead and feel free to leave a like. If you're not subscribed, go ahead and subscribe. If you guys have any requests, go ahead and leave them down in the comments below, and I can add them to the list. Let me know what you guys have any questions about anything we discussed here today. And on that note, guys, I hope to guys see you on the next one. Bye.